Hello Keystone investors, welcome back to the channel. Have you ever wished for a type of digital money that combines the advantages of cryptocurrencies but without the roller coaster like price swings? That's where stablecoins come in. As their name suggests, stablecoins are cryptocurrencies that are designed to stay at a constant value. Here's how they work. Each stablecoin is usually pegged to something of value, like the US dollar. This means that a stablecoin always aims to equal the value of the asset that is pegged to. Why does this matter? Well, in the world of cryptocurrencies, prices can change rapidly. Stablecoins offer a way to enjoy the benefits of digital money without the worry of sudden price changes. They are like a port in a storm for traders when the crypto markets get choppy. Now in the next sections, we're going to dive deeper into stablecoins, exploring how they work, their benefits and risks, and their important role in the digital finance world. Understanding stablecoins can give you a significant advantage, whether you're planning to invest, trade, or just want to keep up with the fast-paced world of digital finance. And stick around till the end because we'll be discussing some future predictions for stablecoins that you definitely don't want to miss. Now you might be wondering how stablecoins maintain their value. Unlike other cryptocurrencies whose value is dictated by market forces, stablecoins employ a variety of methods to ensure that their value remains stable. Firstly, we have fiat collateralized stablecoins, which are the most straightforward. These are backed by a reserve of traditional money, usually in a 1-to-1 ratio. For example, if a stablecoin is pegged to the US dollar, the issuing company should have an equivalent amount of dollars in reserve for every coin issued. If a stablecoin holder wants to cash out, they can trade their stablecoin for an equivalent in fiat currency. This backing by tangible assets help maintain a stable value. Secondly, we have crypto collateralized stablecoins. These are stablecoins backed by other cryptocurrencies. Because cryptocurrencies can be volatile, typically more than one unit of cryptocurrency is required to issue one stablecoin, providing a buffer against price fluctuations. Now, smart contracts manage the issuance of these coins, automatically adjusting the collateral needed to maintain a stable value. Finally, we have algorithmic stablecoins. These coins aren't backed by any reserve. Instead, they use a software algorithm to automatically adjust the supply of stablecoins based on demand. If price falls below the peg, the algorithm reduces the supply to increase the price. If price rises above the peg, it increases the supply to decrease the price. Now, these are the primary mechanisms through which stablecoins maintain their stability. Each type has its own benefits and challenges, and understanding them is key to making informed decisions in the world of digital finance. As we move on, we'll take a closer look at some of the most well-known stablecoins in the market. First up, Tether or USDT, which is one of the most widely recognized stablecoins. It's a fiat collateralized stablecoin, meaning it maintains its value by holding reserves of fiat currency, in this case, the US dollar. For each USDT issued, there is an equivalent amount of US dollars held in reserve. This 1-to-1 ratio is meant to inspire confidence and maintain stability. Now, Tether plays a significant role in the crypto market due to its wide acceptance and high liquidity. Next, we have USD coin or USDC. Now, like Tether, USDC is also a fiat collateralized stablecoin pegged to the US dollar on a 1-to-1 basis. What sets USDC apart is its open financial infrastructure built on Ethereum. It's issued by a consortium called Center, co-founded by Coinbase and Circle, which are among the most reputable companies in the crypto space. Finally, let's talk about DAI, a crypto collateralized stablecoin. Unlike USDT and USDC, DAI is backed by other cryptocurrencies, primarily Ethereum. Created by maker DAO, DAI maintains its peg to the US dollar through a system of smart contracts, which automatically adjust in response to market dynamics. This decentralized approach has made DAI a popular choice in the decentralized finance or DeFi sector. Now, these are just a few examples of stablecoins. Each has its unique approach to maintaining stability and has carved out its niche in the crypto world. In the next section, we'll compare stablecoins with traditional cryptocurrencies. Alright, let's now dive into the differences between stablecoins and traditional cryptocurrencies. We'll compare them in terms of volatility, use cases, and risks. So let's start with volatility. Traditional cryptocurrencies like Bitcoin and Ethereum can see their values change dramatically in short periods. This volatility can be a double-edged sword. It's possible to make large gains, but equally possible to experience significant losses. Stablecoins, on the other hand, aim to maintain a steady value, usually pegged to a fiat currency like the US dollar. This stability makes them less prone to dramatic price swings common in the rest of the crypto market. Now let's talk about use cases. Traditional cryptocurrencies have been used for a variety of purposes, as a medium of exchange, a store of value, or even for computational services, as in the case of Ethereum. Stablecoins, though, due to their stability, have found specific niches. They serve as a safe haven during market turbulence, are used to facilitate transactions in the DeFi space, and can be a more predictable way of transferring value across the blockchain. And finally, there are risks. With traditional cryptocurrencies, there is a risk of losing substantial part of your investment due to market volatility. With stablecoins, however, the risks are different. For fiat collateralized stablecoins, there's the risk that the issuer does not have enough reserves to back up the coins in circulation. For crypto collateralized stablecoins, a sudden drop in the value of the collateral could destabilize the coin. And for algorithmic stablecoins, there's the risk that the algorithm may not respond effectively to market dynamics, causing the coin to lose its peg. In a nutshell, while stablecoins and traditional cryptocurrencies share many features, they also pose unique characteristics that make them suitable for different purposes. Understanding these differences is crucial when navigating the digital finance landscape. As we go further, we'll discuss how stablecoins play a crucial role in the burgeoning DeFi sector. Let's shift our focus now to an intriguing and fast-growing part of the crypto universe, decentralized finance, or DeFi for short. In this sector, stablecoins hold a crucial position because they're both stable and compatible with many different systems. Now, DeFi is a term for financial services that are built on the blockchain technology, particularly Ethereum, which allows anyone to borrow, lend, trade, and invest in their assets. What sets DeFi apart from traditional finance is its decentralized nature. It's finance without a central authority, like a bank or a government. Stablecoins are crucial in this space for several reasons. First, they provide stability in sectors known for volatility. Imagine you're lending your assets on a DeFi platform. You would prefer the value of those assets to remain constant during the loan period. This is where stablecoins come in, offering a predictable value over time. Now, stablecoins also enable transactions in DeFi. Whether it's lending platforms, yield farming, or liquidity provisions, stablecoins are often used as a medium of exchange. In DeFi lending platforms, users can lend or borrow assets, including stablecoins, in a peer-to-peer manner, earning or paying interest directly with other users. By lending stablecoins, lenders can earn interest on assets that maintain a stable value. Now, yield farming, another popular DeFi activity, involves users moving their assets around different protocols to maximize returns. Again, stablecoins are often the asset of choice because of their stability. Now, lastly, stablecoins are commonly used in liquidity provisions. In DeFi, users can deposit their assets into liquidity pools, which are then used to facilitate trading on the platform. As a reward, these liquidity providers earn transaction fees. Now, given their stability, stablecoins are often preferred for this role. By playing these vital roles, stablecoins are fueling the growth of the DeFi sector, and it's an area that's only expected to expand. As we've seen, stablecoins are a fascinating and a vital part of the crypto world. But what does the future hold for these unique digital assets? While nobody can predict the future with certainty, there are some intriguing possibilities. One prediction is that stablecoins could become even more integrated into our everyday financial systems. We've already seen companies like Visa announce plans to allow payment settlements using USD coin or USDC. This kind of mainstream adoption could see stablecoins become a common method of payment, both online and in the real world. Additionally, as the DeFi sector grows, stablecoins could take on an even more significant role. Even more complex financial services and products could emerge, all facilitated by the stability and interoperability of stablecoins. Regulation will also likely to play a part in shaping the future of stablecoins. As governments around the world grapple with the challenge of regulating cryptocurrencies, the rules they set could impact how stablecoins are used and their role in the wider financial system. Now, as we wrap up, it's clear that stablecoins occupy a unique position within the crypto landscape. By offering stability in a volatile market, they serve as a crucial bridge between traditional finance and the new exciting world of decentralized finance. So whether you're considering investing, trading, or just wanting to understand the evolving digital finance world, gaining a grasp on stablecoins is incredibly important. They represent a fascinating blend of the old and the new, merging the stability of traditional assets with the innovation and flexibility of cryptocurrencies. And that is the end of our journey. We hope this exploration of stablecoins has been insightful and helps you navigate your crypto expedition with greater confidence. Stay tuned for more deep dives into the exciting world of cryptocurrencies. And remember, there's always more to learn and understand. So whether you're a seasoned crypto enthusiast or just starting out, keep exploring, keep asking questions, and keep up with the rapidly evolving world of digital finance. Thanks for joining me on this journey, and I look forward to seeing you in the next one.